In this presentation, we will discuss the concept of retained percentage and bond anticipation note as they relate to capital projects for governmental accounting. Anytime we think about capital projects for governmental accounting, we want to think about three main areas that we will have potential recording in. One being the government-wide activity, that thinking about the entity as a whole on an accrual basis. Then we have the typical funds that we might be dealing with. One, capital project fund. Two, debt service fund. When we think about the capital project and debt service fund, those are going to be governmental funds, therefore on a modified accrual basis as opposed to the government-wide activities on the accrual basis. Keeping that in mind, let's first talk about the retained percentage. A retained percentage, government holds a portion of a contractor's fee to cover any construction issues that may happen. So note what we're saying here is that we have a contractor. The contractor has been contracted to build the capital project such as a building, such as a bridge. They have done some of the work, completed some of the work, have billed some of the work. We pay them for the billing of the work as they go, as is the agreement. However, we don't pay them all of it. We're going to hold on to some of it, even the part that they have completed, because we want to have a retained percentage. And the retained percentage then is going to be recorded in contracts payable retained percentage. So in other words, if we think about this process, we can think that the first thing that's going to happen is we're going to have an agreement or a contract with the contractor in order to build a building or something like that, a long-term type of project. When that happens, typically in the government-wide activity, there's not going to be any transaction because we have an agreement, but nothing has been done. In the capital project fund, however, we possibly would record an encumbrance to show kind of that holding account to show that we do have an agreement, and that's going to be a holding account until we're able to record the expenses. Then the contractor is going to do work. They're going to start to construct the building or the bridge or whatever it is that they're going to construct. Because it's a long-term project, though, they're going to bill us as we go. So we're going to have progress billing as they construct the building, and we're going to pay them as they go. So they're going to bill us as they go. When they give us the bill for work that has already been done, we then owe them for the work that has been done. In the government-wide activities, we'll credit the liability for the contracts payable. We owe them, and we'll debit the fact that we have the building in process, work in process with regards to the government-wide type of activity, the asset that's being made by the contractor. Then, of course, we'll pay them. Once we pay them, we're going to remove the cash. We're going to credit cash. And we'll debit the contracts payable, but we're not going to pay them all the money, even though they have completed the work up to that point in time of what's in the contracts payable. We're going to retain some of it, keep some of it, and we're going to keep some of it in case there's a future problem, and hopefully in order to retain the contractor to make sure that they complete the project. So therefore, the liability of the contracts payable is just basically a liability type of account. The liability is reduced when the amount is paid to the contractor or used to satisfy a problem with construction. So if there's any kind of problem, that's why this is here. We're going to have to pay for it. We're going to say, oh, that's okay. We've retained some of it. We're going to pay for any kind of problems with the retained percentage, or we'll pay it to the contractor when it's due to them at the end of the project. Typically is going to be the terms. We're going to say, hey, we're going to hold on to our retainer, and we know you've earned it. We're going to hold on to it until you complete the project, and then if there's no problems related to the project, then we'll pay you out whatever's owed to you at that time, plus the amount that we have retained. Now we'll discuss a bond anticipation note payable. So if we think about a bond anticipation note payable, this typically takes place. We can think about a situation where we have a long-term type of contract or construction project that we want to make again. We want to make a building, we want to make a bridge, and we need to finance that. We're going to finance it with a bond. So we're going to finance it with a bond. However, it takes a while to get the bond in place. The complexities of setting up the bond might take a while. We might want to start the construction project now, and therefore we might set up a bond anticipation note. A bond anticipation note anticipating the fact that we will be able to finance it with the issuance of a bond shortly. Therefore, the bond anticipation note payable is a form of temporary funding while the complexities of dealing with the issuing of the bond is handled. So we're going to say, hey, we need some short-term funding now. We're going to issue a bond. We'll have the bond payable soon. Right now, we need some funding to get started on the project. Now, the funny thing about a bond anticipation note payable is that you would think it's going to be short-term in nature, and it typically is, because we're going to have this short-term note until we finish the process of financing the bond. Once we issue the bond, in other words, we're going to pay off this short-term bond anticipation note payable. Therefore, you would think it would go on the books as a current liability. However, we might think that it should go on the books as a long-term liability because, in essence, we have this loan short-term bond payable that's there in order to have the long-term financing that will result once we issue the bonds. So there's two kind of issues we have here. One is in the government-wide type of activity, which is on an accrual basis, where we have short-term and long-term activity in terms of payables. Should we record it in the short-term or long-term or current or long-term liabilities within the government-wide type of activities? Also, we have the fund activities. When we consider the bond anticipation note payable with regards to the funds, we might think, well, under a modified accrual basis, if it was short-term or current, then it should be recorded on the funds. And typically we're going to say, well, it doesn't really make sense for us to record the bond anticipation note payable on the fund accounting, even though it's short-term, because in essence, it's there to finance long-term debt because it's going to be paid off once we issue the bonds, which is going to be a long-term debt. So for that reason, it may be recorded in terms of long-term if the following are met. 1, all legal steps have been done to finance the bond anticipation note, and 2, intent is supported by an ability to consummate refinancing the short-term notes on a long-term basis.